Hey everyone, welcome back to Corporate Decoder, the place where we decode the financial mysteries of public companies. Today, we're diving into IMAC Holdings Incorporated's latest quarterly report, and let's just say it is a wild ride with some pretty surprising twists and turns. Now, IMAC Holdings Incorporated is a company we've touched on before, and they're in the business of providing services related to proteomic products that help with cancer treatment decisions and drug development. They've had a bit of a transformation, moving away from their previous models like regeneration centers and retail and really focusing on this precision medicine in cancer treatment. Let's jump right into the financial statements because that is where the real story unfolds. Looking at their condensed consolidated balance sheets, we see a snapshot of their financial health. For the period ending the 30th of September 2025, their total current assets stood at about $310,000, a significant drop from over $684,000 at the end of 2024. This means the quick assets the company can easily turn into cash have decreased quite a bit. On the other side of the ledger, their total current liabilities jumped up to over $13 million by September 2025, from around $7.2 million at the end of 2024. That is a huge leap in short-term debts they need to pay soon. And perhaps the most striking figure on the balance sheet is their total stockholders deficit, which ballooned from a negative $5.6 million at the end of 2024 to a negative $13 million by September 2025. This simply means the company owes way more than it owns, and the owner's stake is deeply in the red. Now let's look at how they performed in terms of income and losses. This is where things get really interesting or perhaps concerning. For the 3 months ending the 30th of September 2025, their net revenue was a mere $21,223. That is down from $56,300 in the same period in 2024. So revenue is shrinking, and when we look at their gross profit, which is what is left after you subtract the cost of selling their services, it is negative for both periods. In the 3 months ending September 2025, they had a gross loss of over $102,000. This indicates they are spending more to deliver their services than they are earning from them. This negative gross profit, coupled with significant operating expenses like general and administrative costs, leads to a substantial operating loss. For the 3 months ending the 30th of September 2025, their operating loss was nearly $2.6 million. That is up from about $2 million in the same period in 2024. And when we factor in everything else, including interest expenses, their net loss widened considerably. For the 3 months ending September 2025, they reported a net loss of over $3 million compared to a loss of about $2.2 million in the same period last year. Looking at the 9-month period ending the 30th of September 2025, the story is similar but on a larger scale. Their net loss from continuing operations was over $7.3 million, a significant increase from about $3.9 million in the first 9 months of 2024. A major factor contributing to these increased losses is a one-time expense. In the 3 months ending September 2025, they recorded a loss on impairment of property and equipment of over $748,000. This means they had to write off the value of some of their assets because they are no longer worth what they thought. Specifically, this relates to laboratory equipment acquired in May 2024, which generated very little revenue. Let's talk about debt. Their notes payable are a substantial concern. At the 30th of September 2025, they had a 40% OID promissory note with a due date in November. December 2025, worth over $4.2 million. OID stands for Original Issue Discount, and a 40% rate is incredibly high, suggesting a very risky loan or a very distressed borrower. Their total notes payable at that point, after accounting for discounts, amounted to over $3.8 million. This is a huge burden given their current revenue and losses. The shareholders deficit section reveals more about the company's capital structure. They have preferred stock, and a significant amount of it, the liquidation preference value for all their preferred stock series, is over $57 million. This means that in case of liquidation, preferred shareholders get paid back first, and there is a lot of preferred stock out there. The number of common shares outstanding has significantly increased. In 9 months of 2025, they issued over 329,000 shares for cash under a common stock purchase agreement. Now, let's look at net loss per S-share because that directly impacts what each share of common stock is worth in terms of earnings. For the 3 months ending the 30th of September 2025, The net loss per S-share was a whopping negative $1.15. This is compared to a negative $1.76 in the same period in 2024. While the per share loss has decreased, it is still a significant loss. The weighted average common shares outstanding have also increased substantially to over 3.7 million for the second quarter of 2025, up from around 1.9 million in the same period in 2024. This increase in shares, while overall revenue is down and losses are up, means the value per S-share is getting diluted. IMAC Holdings also faces several ongoing legal and regulatory challenges, particularly related to past operations. They are involved in a dispute over alleged overpayments related to their discontinued operations, specifically Progressive Health. Covent Bridge, a contractor for CMS, recommended an overpayment of about $2.7 million based on a statistical extrapolation of claims. The company has been appealing this since 2021, and while there have been some partially favourable decisions, they have taken the case to federal court. Similarly, there is a notification from Covent Bridge regarding alleged overpayments for Advantage Therapy, estimated at about $0.5 million. They received a partially favourable decision on reconsideration and are awaiting a response from an administrative law judge hearing. Another notification from Covent Bridge estimates an overpayment of about $1.1 million related to their IMAC St. Louis Patient Center for operations between February 2020 and January 2024. Looking at their property and equipment, it is interesting to see the impact of that impairment charge. As of the 30th of September 2025, their net property and equipment is listed as zero. This contrasts with over $900,000 at the end of 2024. The note clarifies that depreciation and significant impairment charges have reduced the net value to zero. Now, let's touch on something crucial: their internal controls. The report states that their disclosure controls and procedures were not effective as of the 30th of September 2025. This is because of several material weaknesses, including insufficient resources in their accounting department, leading to difficulties in applying complex accounting principles, issues with the segregation of duties, and a failure to sufficiently design and implement operating controls surrounding accounting policies. Essentially, their internal financial reporting systems are not as robust as they should be. They are hiring consultants and plan to improve these controls when they have more capital. So, what is the big picture here? IMAC Holdings is really trying to pivot its business towards precision medicine in cancer treatment. They've sold off or closed down other operations, which is a strategic move. However, the financial numbers paint a picture of a company facing severe challenges. Revenues are down, losses are up, and their debt load is a major concern. The high interest rate on that one promissory note is a red flag. On top of that, they have these ongoing legal battles related to past operations, which could mean significant future costs. The fact that their net property and equipment is zero after a large impairment charge, and their internal controls are deemed not effective, really highlights the precarious position the company is in. They acknowledge in their report that there is substantial doubt about their ability to continue as a going concern, and they plan to raise more capital. The increase in common shares outstanding also suggests they might be diluting existing shareholders to raise funds. Looking at the strategy, focusing on proteomic products for cancer is a potentially high growth area, but translating that into profitability has been a struggle. They need to significantly increase revenue and manage their costs much more effectively. The legal issues also pose a significant unknown and potential future drain on resources. For investors, this looks like a very high risk situation, where the future hinges on their ability to secure substantial new funding and turn around their operational performance quickly, all while navigating these legal challenges. Alright, that is our breakdown of IMAC Holdings, Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.